Financial Secrets Revealed podcast, where we are still in collaboration with Allan Gray Australia. Now, today I'm very privileged to have another one of their wonderful portfolio managers with us. Please meet Dr. Suhas Nayak. I hope I've said that properly, Suhas.
Yes, you did.
Excellent. Now, welcome. Can you tell us a little bit about yourself?
So I'm a portfolio manager at Allan Gray. I manage about 35% of the Allan Gray Australia Equity Fund. I've been with the firm since 2011 and have been a portfolio manager since late 2016. Before that, I was a consultant at a management consulting firm, and ancient history now. I did a PhD in mathematics at Stanford.
Okay, now PhD in mathematics, and I believe you've got very young children still in the single digits. How are you helping your 9-year-old with the homework with a PhD in mathematics?
Yes, I try, although arithmetic, I don't know if it was ever my strong suit, so it's testing me.
Some of the stuff I've looked at that the kids bring home these days, I'm like, oh my goodness, I don't remember anything this complicated this young. So yeah, it's a whole new world, that's for sure. That's
true.
All right, now we're going to do a little bit of a deep dive into the equity fund today. So I'll look forward to asking you some questions about that. But as I've asked Simon and LJ, Allan Gray is known for being contrarian. Can you explain what that means to you and how it's worked into the Allan Gray approach?
Yeah, I think contrarian is really just a philosophy of investing that involves looking for opportunities that may be out of favor for whatever reason, and finding a reason to make an investment in those sorts of opportunities. So the reason for doing that is that we believe the best opportunities come from situations where people are afraid of the future for whatever reason, and you get those opportunities at the best possible price. And I think one of the most important determinants of future returns is the price that you pay when you first invest. And I think being contrarian helps you get good prices for assets.
And contrarian sounds like you're going against the grain. You're not doing what the herd is doing. Can you share a time when you really did have to hold your nerve while others were going the other way and you're going, no, this is the best way to be. We're going against everyone else right now?
I think almost every position in the portfolio has an element of that. And I think when we make our first investment, one of the key considerations is to understand where people's sentiment is on the stock and why we might be buying it from someone who is probably just as smart as us, if not smarter, but for whatever reason deciding to sell those stocks to us at that particular point in time. So making sure that we stay true to that contrarian philosophy is a really important part of the process. And so most of the stocks we're invested in have that element to it. One recent example is ServiceStream. So that was a company that we first invested in 2021, mid-2021, and we sold our last shares just recently in the stock. So it's a full life cycle of that contrarian investment, which might be worth highlighting here. So ServiceStream is a services company. It does all sorts of maintenance contracts for companies and governments around the country. Also operates in the telco sector, utilities sector. And back in 2021, it had a few problems with a utilities contract where there were some cost overruns and some losses. And for whatever reason, I think the market took a view that these were potentially systematic problems in the company, and took a dim view of the shares. And as that happened, the shares got sold off pretty aggressively, so much so that it started to get excluded from index funds as well. And when that happened, the selling accelerated, but it also gave us the liquidity opportunity to get into the stock. So we were buying this company at around 80 cents, sometimes even lower than that. And we got up to about a 20% shareholding in ServiceStream. Fast forward 3 years or so, and some of those risk management issues that were identified back then, those concerns have dissipated. The company has done quite well, and I think is now getting included in the very same indices that it was excluded from 2 or 3 years ago. So if you think about it, an index investor sold us those shares at 80 cents and are now buying back those shares at $1.80.
Wow.
Those very same shares.
Yeah.
And so we have gone in the opposite direction now and sold those shares because we think they've reached our estimate of intrinsic value, more or less.
So for you, I suppose it's very much underpinned by the research that you're doing, because we spoke about, when the market's going one way and everyone gets all excited and jumps on the bandwagon, which is like, oh, this company's done really well, let's grab it. You're going, actually, we've made our money. We did the research. We thought they were great. So it's not terrifying. It's just, look, we've looked at all the research and this is what it's based on. So it's not terrifying to go that opposite direction.
Yeah, I think part of our process is also just trying to understand what a realistic downside looks like, and we try and protect ourselves against that downside. And so in the case of ServiceStream, we tried to understand what downside margins would look like. And for most of these companies, downside margins in this services sector look like 2.5%. And if those margins and those earnings are more than adequately reflected in the share price, then it acts as a bit of a backstop for us and makes us more comfortable buying a bigger position. Because sure, in the short term, maybe those earnings fall below those sorts of margins, but in the long term, it's likely that the company, if it has a right to exist, will earn those sorts of margins, and those earnings will then get reflected in a higher share price.
Excellent. Can you tell us a little bit more about the equity fund and how it's set up and what sort of minimums and maximums are allowed within the fund and where it's currently sitting at the moment?
So we think of the equity fund as having about 40 stocks, and we think of a single position in the fund as being about 2.5%. But we scale our positions based on where we think the downside is in each of these stocks. So, for example, a company where we think there is a large potential downside will have a lower weight in the fund, and something with a shallower downside would typically have a much higher weight. We invest across the ASX 300, so there's no minimum size per se, but practically speaking, we look at sort of companies around $500 million market cap and above, and we will scale our position based on that downside that we talked about.
So being contrarian, how are you then balancing maintaining a differentiated portfolio with those 40 shares when you have to manage drawdowns and obviously there's performance volatility on a day-to-day basis as well? So how does that work?
Yeah, so performance volatility and drawdowns are unfortunately a natural part of our investing style. We don't shy away from taking a differentiated view to the portfolio and having stocks that are quite different to what a lot of other managers might hold and what the benchmark holds. And so volatility with respect to relative performance to the benchmark is a natural consequence of that high active share that we have. So those sorts of things, though, do tend to correct themselves in the long term as the fundamentals start to shine through. Yes, there are short periods, hopefully, of underperformance and drawdowns, but in the long run, we expect fundamentals to come through.
Now, I know Australia's historically very heavily weighted to the financials and the mining sector. Being contrarian, I'm guessing you've got a much lower allocation to the most expensive banks in the world at the moment. But I hear you have a higher exposure to materials and energy. So can you talk about what mispricings you're seeing in that space at the moment?
Yeah, so you're right. We do have a very low exposure to the biggest part of the financial sector, which is the big four banks. I think everyone has talked about those valuations being crazy, and we would tend to agree, which is unusual. But yes, we would tend to agree with that. It's very hard to justify the sorts of valuations that we see there relative to the sorts of growth that those banks deliver. Having said that, it's not just the financials that have really delivered the performance of the ASX. It's also companies like Wesfarmers that are trading at very high multiples relative to the growth they deliver, and also companies like Goodman Group that have high multiples despite a good chunk of their earnings being pre-tax earnings. And so for an end investor like us or our clients, there's tax to pay. And so the multiples are actually even higher than the headline numbers would suggest. So having parked those companies for being quite expensive, we do need to look at other sides of the coin. And I guess one of those other sides is materials. So we do have overweights to companies like Alcoa, which price in pretty poor profits per ton out of their main products. Alcoa is an alumina and aluminium producer, and it trades well below any estimate of replacement cost, and the sorts of profits that are priced in would result in very low returns on the currently established base of assets. And so we think this is a reasonable place to be. Newmont is another company that we have exposure to, trades at about 12 times PE at current gold prices. So the market obviously expects much lower gold prices into the future. And one other materials name that we're invested in is Sims. It's a metal recycler. It trades at a slight premium to NTA, despite having a large amount of surplus land to its name, and also a very fast-growing capital-light business that they call recycling the cloud, which essentially recycles components out of data centers and the like, which is a very hot area of the market, but Sims doesn't seem to enjoy any of the multiple benefits that other companies that are tangentially related to that space seem to get. So those are three such companies in materials, but I think we have quite a broad range of investments in a number of different companies that aren't necessarily just materials resources names either, and it's one of the few times that we've seen a lot of companies get left behind just because of the narrowness of the outperformance on the ASX that has happened more recently.
So how do you then identify and monitor things like, I suppose, sentiment even, where, you might think the fundamentals look really good and the market's going, no, don't like it. And, an example might be Fletcher Building or Lend-Lease. How do you then work out, are they going to come good again? When's the market going to change their mind? What do you do in that space to monitor and check on those companies?
Yeah, we're always assessing whether the investment still makes sense relative to the price that's currently on offer. And so that is a key consideration. And every 6 months, we get to reassess with some new facts and new numbers that are released by the companies. So a company like Fletcher Building, we think they seem to be on the right track, and the share price hasn't reflected anywhere near the sort of mid-cycle earnings that the company used to enjoy. So currently, Fletcher Building trades at a slight discount to the market multiple, despite its earnings being quite depressed and exposed to a New Zealand economy that has also been incredibly depressed. That is a rare combination, buying depressed earnings at a low multiple. Those are the sorts of opportunities we love to see, and we always question why we're getting that kind of opportunity. There are obviously risks around Fletcher that the market is worried about. For example, there has been a decade of really poor decision making at Fletcher that has probably eroded some of its competitive advantage. But notwithstanding that, we think mid-cycle earnings are quite a bit higher. And I guess the question is, how long will it take to get to that mid-cycle earnings number? But they seem to be managing this difficult, challenging time in their history better. There's been a management change there, there's been board changes, and there's been a really forensic effort to understand what drives value in the company, and hopefully they're making the decisions that set themselves up to prosper when mid-cycle comes around again. And Lendlease, I guess, that has been a difficult investment. It currently trades below NTA, which is somewhat unusual for a developer. And it also has earning streams that aren't really attached to any sort of tangible capital, like construction, like investment management. And so it's rare to get these sorts of companies at below NTA. In terms of signposts, as you alluded to, I think one good signpost in the Lendlease journey was this last report, annual report that they released, where for the first time in quite a while they delivered cash flows and a profit. And so I think that has reassured us to some extent that they're on the right path. But this is a long-term turnaround story.
Yep.
So I'm sure there will be bumps along the way.
So you've got these 40 stocks in your equity portfolio. Now, the last 12 months, you've had quite a high turnover in these stocks compared to the 12 months before that. Have you changed how you do things, or you just think there's more opportunities? What drives those decisions on turnover in the portfolio?
So there has been slightly higher turnover. We like to think of the fund as having an average holding period of about 4 to 5 years. But last year's turnover was somewhat higher. One of the key drivers of that, though, was a takeover of one of the companies in the fund, which forces turnover because we basically sold into the takeover. That takeover was Virgin Money, and it was about a 5% position in the fund. So if you adjust for that, then our turnover wasn't that much higher, and there hasn't really been any change to the way we manage the portfolio. You would expect us to typically be rotating out of companies that have done well and into companies that have underperformed, and we did that throughout last year as well. I guess one key difference, though, was that there were a couple of large companies that did particularly well, QBE and Newmont, and a whole swathe of companies that underperformed. And it was because those two companies did well quite quickly, we had the opportunity to reallocate more quickly than we would otherwise do. And so turnover was slightly elevated once you adjust for that Virgin Money takeover.
So being underweight in the large cap space and the financial space, let's talk downside protection then, because people are worried about the macro risks in the world at the moment. How do they get managed in the fund?
Yeah, so we think the greatest protection you have is the price you pay. So buying companies that reflect poor sentiment or poor outlooks at good prices help you manage that downside. perhaps not in the very shortest of terms, because if there is ever a market correction, everything gets sold off. But in the eventual rebound, you typically see those companies that have not started off at really high places start to recover more quickly, and I think that's how we kind of justify being in the companies we're in. You're right. There's the financial exposure is low at the moment. The large cap exposure is also lower than the benchmark, and I think both of those have been driven by where we see value, and large caps have been bid up very strongly over the last 2 to 3 years, and so the downside protection just isn't there. Because when valuations get stretched, those are the very companies that get sold off hardest, typically.
So the Australian market continuing to go up at the moment, rallying. When it's been running this well this long, that's when I start getting nervous. How do you avoid value traps and maintain valuation discipline when everything just, it doesn't matter where you invest, it all seems to be going quite well?
Yeah, I think that is true. The market has done very well. It has the performance has been quite narrow though, so it's just a handful of stocks that have driven the majority of that valuation increase. And so, in some ways, in a relative sense, there are probably 290 stocks out of the 300 that are fair game, at least for digging deep and looking at potential relative value. So that's where we're focused in those companies that haven't done particularly well. I think, unfortunately, though, part of the process means that that we are going to be in value traps at times. But hopefully, our process is such that we don't get carried away either. We don't buy into the exuberance. We're always trying to make sure that we're finding the opportunities that people don't like for whatever reason.
So we know risk is a part of investing, especially when we're talking about share funds and equity funds in particular. How do you manage that risk for your customers in the investment process? Is it just that contrarian approach, or is there more to it?
Yeah, I think it's the contrarian approach together with sizing. So we size our opportunities based on the risk we see to the downside. Low risk of downside, higher weight in the portfolio. Higher risk of the downside, generally a lower weight in the portfolio. Those are two examples. I think the team is set up to kind of make sure that we're focused on facts, not opinions. And I think when you're focused on the facts and you don't get carried away by the opinions, it sort of mitigates some of the risk of paying too much for things. And yeah, that focus on facts and numbers is a key part of our process.
So what sort of investor is best suited to the equity fund? Who would be best to invest in that?
Yeah, I think it's typically investors who want something a little bit different, something quite differentiated from the benchmark, but want to be invested in equities. It is a 100% invested portfolio, but in companies that have long-term earnings prospects and long-term valuation upside. Those are the types of investors that can stand to benefit from an investment in the equity fund.
And the time horizon, you said 5 to 7 years earlier, that applies for the investors as well to stick around longer term?
I think so. I think a lot of these stories take that 3 to 5 to 7 year time horizon for things to play out. Some of our best investments have been very long-term holdings in the fund, and although there have been several that have worked out in the space of a year, and ideally a year and 1 day would be great, but that's not how things often turn out. But yeah, a longer-term time horizon is
the key. Excellent. Now, I did ask Simon as well, is there a book or concept or a thinker? Now, you've obviously done a lot of study that has shaped how you approach markets and decision making. Obviously, you've got a background with McKinsey and now Allan Gray. Is there something that stands out to you about why the contrarian approach suits?
I think one of my favorites is Howard Marks's The Most Important Thing. I think he really laid out, that contrarian approach, and it's something I read before I joined Allan Gray just to get a better sense of how the whole contrarian mindset worked, uh, which was very helpful. So yeah, I highly recommend that book for good insights into long-term contrarian investing.
So outside of contrarian investing, do you go against the grain anywhere else, Suhas? Or is that a question I ask your wife?
I think it's harder to do in your personal life. It is quite hard. I think the thing about investing and markets is that people make prices. It's not some natural law that creates the price that you see for an asset. It's just two people turning up to trade on a particular day that decides what the price is, and that means going against the grain means really going against the sentiment that the counterparty has. And you can stand to benefit when the sentiment is extreme for whatever reason. That's harder to do in the rest of society or the rest of the life, because particularly in scientific things, going against consensus may not be the right thing to do. Yeah, there's
your wife might not like you disagreeing with everything she says.
But there have been times in the past where, for example, I think when Malaysian Airlines had its difficulties and its horrible accidents, etc., it was clear that those were not airline specific, and there were you could get good pricing on Malaysian Airlines tickets at times, and that was something that as a consumer you could benefit from. But it's harder to do that in a lot of other instances, I think.
For sure. If there's a tip for end investors, do you think there's something that people get wrong or wish they understood better about investing?
I think, a lot of people talk about great companies, and I think great companies and great investments don't necessarily go hand in hand all the time, because there is a particular thing called price that sort of mediates what happens between great companies and them being great investments. And if you pay too much for something, it doesn't necessarily make it a great investment. And so I think that is one thing. Price matters is probably the big thing that I think people would benefit from knowing.
Excellent. Well, thank you for sharing your wisdom with us today, Dr. Suhas. We appreciate that, and doing the deep dive on the equity fund. Thank you again for joining us.
Appreciate it.